Hi, everybody, and welcome back to Chapter 8, video number 1. In this chapter, we're going to look at inventories and some additional valuation issues. Okay, our learning objectives are we're going to look at describing and applying the lower of cost or net realizable value rule. We'll take a look at describing and applying the lower cost or market rule, and identify other inventory valuation issues, determine ending inventory by applying the gross profit method, and determine ending inventory by applying the retail inventory method, and finally explain how to report and analyze inventory. So, previewing the chapter, we're going to look at the lower of cost or net realizable value. What the definition is, of course, an example or illustration, how we would apply it, and then adjusting it to the net realizable value. We'll also look at how lower of cost or market works, methods of applying lower of cost or market, and evaluating the lower of cost net realizable value and lower of cost or market. Notice the slight differences in definitions here from what you had in Accounting 1A and 101. Okay, there's other valuation approaches. Here we'll look at net realizable value, relative sales value, and purchase commitments. We also are going to look at the gross profit method of estimating inventory. Here we'll compute gross profit percentage, evaluate what the gross profit method means. And then when we do the retail inventory method, we'll look at what the overall concept is, the conventional method, some special items, and evaluation. And then finally, we'll take a look at presenting and decision-making analysis. All right, let's get into the meat of the chapter. Here we're going to describe and apply the lower of cost or net realizable value rule. Now, a company abandons the historical cost principle when the future utility, that's the revenue producing ability of that asset, drops below its original cost. We'll look at defining what net realizable value is. And estimated selling price in the ordinary course of business less reasonably predictable costs of completion, disposal, and transportation. Okay, completion, disposal, and transportation. Okay, what's the definition of net realizable value? Here's an illustration. Assume that Starbucks Corporation has unfinished inventory with a cost of $950, a sales value of $1,000, an estimated cost of completion $50, and estimated selling costs of $200. Starbucks' net realizable value is computed as follows. First, we'll take the estimated selling price here, $1,000. We'll deduct the estimated cost of completion, $50, and the estimated selling costs, $200. Subtracted from $1,000, that gives us a net realizable value of $750. Now, they're going to report that inventory at $750. That means that in its income statement, Starbucks reports a loss due to the decline of inventory to net realizable value of $200. That calculation, let me go back. Here's the $950 cost. Here's the net realizable value, a difference of $200. All right, so let's look at Whole Foods. Here, this is the lower of cost or net realizable value. So here's the food, its cost, its net realizable value column here. So we have spinach, carrot, beans, peas, and mixed vegetables. All right. So now if I look at where the cost is less than the net realizable value, we're going to bring that cost over as the final inventory value. But in the case where net realizable value is less than the cost, we'll bring the net realizable value over to the final inventory value. And so our final inventory value here is $384,000. All right. So the cost of $80,000 is selected because it's lower than the net realizable value. Carrots, the same. The net realizable value for the beans because the net realizable value is lower than the cost. And the same with peas, net realizable value is lower than its cost. And finally, mixed vegetables, net realizable value is lower than its cost. Okay, so now an alternative application of lower of cost net realizable value. So we can also do this by individual items. And that's frankly how I'm used to doing it, by individual items. And we would have 384,000 applying this approach. However, another method would be major categories. We could look at the total frozen and see that its net realizable value is $30,000 higher than its cost. So we bring over the cost of $230,000. But the cost of total canned is greater than the net realizable value here. So we'll bring the net realizable value of $164,000 over. That gives us a slight difference of $10,000 between $384,000 under individual items and $394,000 under major categories. And if we wanted to, we could just do it by total inventory. Here, our cost is less than our net realizable value, so we can bring the cost over of $415,000. Normally, it's certainly in my experience, an item by item is how we would do the lower of cost or net realizable value. Okay, let's look at the following for Ricardo Company. And they report sales revenue, cost of goods sold, ending inventory at cost, ending inventory at net realizable value. So what are the journal entries we're going to do to net realizable value using 1, the cost of goods sold method, and 2, the loss method, assuming they use perpetual inventory system. And then under Bravo here, how should the income statement for Ricardo be reported if 1, the cost of goods sold method is used, or 2, the loss method is used. So here we're going to look at the cost method, or the cost of goods sold method, and the loss method. So cost of goods sold, let's go back. Here's our 82,000 and the 70,000. So our cost is greater than our net realizable value. So we're going to write this inventory down by $12,000. So here we're going to debit cost of goods sold and credit inventory for $12,000. Now, if we use the loss method, we're going to still reduce inventory here with a credit of $12,000, but the debit is going to be to inventory loss, not cost of goods sold. In a way, that sort of makes sense to me because we haven't sold any inventory. We've just taken a loss on that inventory. But sometimes that inventory loss can be misleading and maybe not be as communicative as the cost of goods sold method. Okay, so how does the income statement look? Here's our sales revenue, cost of goods sold after we've adjusted it to net realizable value, and that gives us our gross profit. Now, under the loss menu, we have a 200,000. Our cost of goods sold is better because we haven't increased it by $12,000 as we did here. So that gives us a gross profit of 92,000, and then from the gross profit we would subtract the $12,000 as the inventory loss here. And both would result in a gross profit on sales of, or I should say, a pre-tax profit of $80,000. Okay, I think that's clear. Now, the Guard Corporation has the following 4 items in its ending inventory. And we have Mike, November, Oscar, and Papa here. We've given costs and selling prices and the costs to complete and sell. So what's the lower of cost or net realizable value for each item? And under Bravo here, the amount of write-down, if any, using a 1, item by item lower of cost or net realizable value evaluation, and 2, total inventory lower of cost net or net realizable value evaluation. Okay, so we can do this relatively easily. Here's our cost, and here's our net realizable value. So we're going to, in this case, the cost is lower than the net realizable value, so we'll pick up cost. And here, the net realizable value is lower than the cost, so we're going to pick up net realizable value. And for Oscar, our cost is lower than net realizable value. We'll pick up cost here. And finally, for Papa, we have cost is lower than our net realizable value, so we pick up cost. And our lower of cost or net realizable value therefore becomes $14,550, $50 smaller than our cost. So that write down really is explained by the November's items write down of $50. There is no write down when performing the assessment on total inventory, because on a total inventory basis, net realizable value was higher than the cost here. Okay. Here we're going to take a look at describing and applying the lower of cost or market rule. And the lower of cost or market rule is the use of lower of cost or net realizable value method works well to measure the decline in value of inventory for most companies. The FASB granted an exception to the lower of cost or net realizable value approach for companies that use LIFO or retail inventory. Rather than comparing the cost to net realizable value, the companies compare a designated market value to inventory cost, and the approach is commonly referred to as the lower of cost or market, LCM. This looks like a good place for us to stop this first video, and when we return, we'll take a look at the 2 limitations of lower of cost or market. Until that time, bye for now.